If you would ask...
Not since 1984 has the Federal Reserve moved so far, so abruptly to stave off market collapse and recession. Shortly before U.S. stock trading opened on Wall Street, the U.S. central bank slashed a key interest rate by 0.75%. In a statement, the Fed said it took this action in view of a weakening of the economic outlook and increasing downside risks to growth. Financial market conditions have continued to deteriorate and credit has tightened. U.S. Treasury Secretary Henry Paulson praised the Fed's move.
And what I think it shows to this country and the rest of the world is that our central bank is nimble and is able to move quickly to respond to market conditions. And I think that should be a confidence builder.
The move came after huge losses battered exchanges in Asia and Europe. Those markets were panicked over fears the U.S. has already slipped into recession, with likely knock-on effects that will soon slow the global economy. On the New York Exchange, the Dow Jones stock index plummeted close to 500 points early on, but then bounced back.
So at least the sort of panic, the sort of fear has been alleviated to some extent. And the question is whether that's just momentarily or whether, in fact, we won't see a return to the kind of panic across financial markets.
The Fed action was a sign of just how deeply concerned Chairman Ben Bernanke and his colleagues are about the prospects of a serious long-term economic slowdown. The roots of the crisis are in the U.S. housing market. For years, as home prices soared, banks wrote too many housing loans to people who didn't have the ability to pay them back. Financial institutions are now stuck with hundreds of billions of dollars in bad loans. Home sales have crashed, credit has tightened, and a huge wave of home foreclosures has swept the country.